Hello, everyone. This is Terry with Futures.io. And as always, I would like to thank you for joining us today. It's my pleasure to welcome back John Grady from No BS Day Trading for today's webinar, Using Order Flow Analysis and Long-Term Trading Strategies. Throughout the webinar, if you have a question, please feel free to type them into the questions box. We'll do our best to answer them at the end of the event. This webinar will be recorded and posted on the Futures.io website within 24 to 48 hours. If you're watching this afterwards on YouTube, please do us a favor and give us a thumbs up if you enjoy. And as always, please feel free to share, comment, subscribe to our channel. It really helps us a lot. For trading news, events, and information, follow us on Facebook, YouTube, and Twitter using @Futures.io. And now, without further delay, I'll hand it over to John, and you'll get the pop-up to share your screen again.
All right.
Hi, she's all yours.
Very good. Thank you, sir. Okay, everybody. Thank you for attending, and thanks again to Terry and Mike for having me back on. I really appreciate it. Always try to help people a little bit during these presentations and just offer some insight. So today, what I'm going to focus on, if you've never seen one of my presentations, normally what I do is I have just a little sheet of notes that I go through, and then I'll have some, like images, and then I'll actually have some trade samples videos that are recorded to go through to help illustrate the ideas. Okay, so the notes just sort of keep me on topic, and I try to push through those as fast as possible and then get to the meat of the presentation as it would be. Okay, so what I thought I would do today in terms of topics, because I get this question a lot, is talk a little bit about how people who might use slightly longer term strategies, we're going to call them swing trades for the most part, can use the order book and volume analysis and price action analysis to possibly help themselves make some better decisions depending on the situation, right? So, and I think when it's all said and done, you'll understand why it could behoove you to look at the depth of market, also, AKA the order book, AKA the ladder, AKA these things right here, right? That's what the ladder, the order book, the DOM is, depth of market, right? So let's just start with this. When I talk about order flow, I'm basically talking about, or order flow trading, I'm talking about making decisions primarily based on price action and volume, which means primarily based upon, sorry, that's a chart. That's not what I'm talking about. Watching the depth of market. Well, when I talk about swing trading, there are obviously different definitions that people have for swing trading, but for our purposes, let's just refer to it as trades that maybe last for anywhere from 30 minutes to 3, 4, 5 hours, day trades, as well as trades which might be held overnight for, let's say, 2, 3 days maximum, just for these purposes again. Often these trades are based on technical analysis, but they can also be based on maybe an anticipation of a news event or something of that nature. And then we have fundamental trading. All right, so with the fundamental trading, you're talking about holding for several days or possibly weeks or even months or years in the case of some funds. And that's going to be based upon a macroeconomic viewpoint, right? What people think the Federal Reserve are going to do, not just in the upcoming announcement, but what they think the Federal Reserve is going to do in the next 3 announcements, right? And so these guys position themselves for that. So those would be the 3 types that I'm going to discuss today, mostly swing trading and order flow trading. All right, and to get started, and again, these presentations, for the most part, they're geared towards newer traders, or maybe traders that have some experience and have traded live, but have never been in the industry, and don't really have a lot of knowledge on all the different subjects. So some of the things that I say seem a little basic to you, you already have some experience, I would ask that you just bear with me on that, because I will get to some more, slightly advanced stuff that could help you. But realistically, when someone attends a presentation like this, usually they're trying to learn some of the basics about how the markets work and the fundamentals. And I mean, you have some people that don't even know what the difference between limit orders and market orders are, right? So anyway, just kind of keep that in mind as I progress. Another part of the presentation that I want to talk about is viewpoints on styles, because there's a little bit of misunderstanding on the parts of some people about my viewpoint on swing trading, for example, and I'll get to that in a second. But you always have to remember when you're researching styles of trading and what you want to do and what might fit your personality, right, slash time frame. If you're looking at information, you always have to question the source, right? That includes me as well. You have to question my background and from where I'm speaking. So a hedge fund manager who has, $1 billion under management, a guy like that, and by the way, I have these notes up too, just so people can read them and, pause recording down the road. A guy who's managing $1 billion is not really going to be focused too much on very short-term scalping techniques, right? Now, most funds do have a desk that runs some kind of high-frequency trading style system at this point in time. But these are also guys that do very long-term trading and sometimes go out, like I said, for years. And so, like what I have here is a guy who sent a team of analysts out to Iowa and Nebraska to do crop yield analysis. Isn't really going to be concerned with the next 3 ticks on a short-term 10-lot trade, right? And a swing trader who maybe only takes a few trades a month and only associates with other people is also not going to have a lot of input on short-term scalping. And so I ask people to keep that in mind when they're listening to what I had to say. All right. So just real quick, I did this chat with Traders interview with Aaron over there, and it's a good site if you haven't visited. And during the interview, he was asking me about using order flow with longer term trading. And so I wasn't really ready for the answer, and I didn't say what I kind of should have said. So I'm taking this opportunity today to sort of present my philosophy a little bit better, so people really understand, what I'm saying. Because if you get on some forums, including this one, sometimes there are people who say that, Grady's viewpoint is that the only people that make money trading are scalpers. And that's not at all my viewpoint. Obviously, there are people who make money doing longer term trading. My viewpoint comes from my history, which is I traded for firms in Chicago. Okay, so I traded for a firm that was on Michigan Avenue. We had lines running to the CME, where the servers are, and the firm was funded and founded by guys who were ex-floor traders who had become screen traders. Okay, I met guys who worked for other firms, also screen trading, and at the time, I still knew guys that had been on the floor or were on the floor. In fact, one guy left our office eventually to go down to the floor, and he was trading hogs and cattle. So, and I knew market makers and whatnot, right? So whenever I share information with people, I guess that's what I'm trying to impart, is that I've been in the industry and I've seen it from the inside, and I worked for firms, and so I'm not sharing speculation on that. I'm actually sharing reality with you. So if you were to have walked into our firm at its peak, you would have seen probably 60 traders in a big room, and every single trader had the depth of market screens up in front of them. Okay, now some traders may have looked at charts, some traders may not have looked at charts, some traders may have been watching some news, some traders may not, some were spreaders, some were outright scalpers. But the point is that every single trader placed his orders through the depth of market, if for no other reason than to see the bid ask, and I'll get to that in a minute, and save ticks on your orders, okay? So even if you're looking for a little bit longer term approach, you really want to have the order book up to give you an idea of what's happening with the bids and the asks and the pace of activity, meaning is it fast or is it slow? Is it dead? Do we have numbers coming out? This type of thing, right? So when I give the presentations, I stay focused on this style because that's my background, right? And that's the background of pretty much everybody that I knew in the business. If you go looking for a prop job, and I get a lot of questions about this, all right? Most prop firms, they put their traders, well, first off, nearly all of them put their traders immediately on the order book to place orders. But the reason they have their traders look at short-term situations, there's a few of them. One is that it's often easier to read the next 5 minutes, the next 3 hours, or 2 hours, or 5 hours, whatever. Two is they want their traders taking advantage of the most opportunities possible. And we'll get to that as well. Three, they don't want to see massive swings in the P&L due to 1 or 2 trades. That's very common. It's even common with guys who are supposedly short-term traders. They get in, they start making some money doing short-term style trading, and then they decide to take a big shot on 1 or 2 trades, and they blow out, 2 months of profits in 2 days, taking 2 trades. And of course, the firms don't want to see that; they want to avoid that, and so they try to steer their traders away from longer-term plays like that. And then 4, they're trying to minimize risk while maximizing gain. And like with a high-frequency trading program, some of them, especially the ones run by market makers, these programs are executing hundreds or literally sometimes 1,000 plus trades a day. And they can do this because they're paying almost nothing in fees and commissions. They have seats on the exchanges, so they pay very little there. They get volume discounts, which reduces their fees even more. And they're self-clearing, which means that they don't have to clear through a broker of any or a clearinghouse. So they're trading for possibly a few cents around turn, whereas the retail trader is usually paying $2-3 around turn. So they can execute these trades all day long at very little cost to them. And what they're often trying to do is just get a tick or two here and there, and then it nets out as a profit at the end of the day. And of course, they account for a lot of the volume, right? So this is what you want to keep in mind. Trading is an auction, all right? Mechanics are not that complicated. It's buy low, sell high. It's a matter of a seller matching an order with a buyer. It really is that simple. And if you're looking to get into the game and you're trying to develop your own strategies, what you want to remember first and foremost is that you're trying to anticipate the next wave of market orders. All right, I'm going to show you that in a second with recordings. But basically, you have to have market orders to move the market, right? So if you have a situation, this is the ES over here on the right side, let's say, this is overnight, and you have 65 offered and you have 12 on the bid, and no one is willing to pay up or down, price doesn't move, right? We all just sit there. I'm offered at 49, your bid at 48.75. Neither one of us is willing to give up that extra quarter. So therefore, nothing happens, right? I know this seems basic, but again, a lot of people who attend, this will help them. In order for a price to move lower or higher, you have to have market orders. So in other words, if I'm bid at a price of 48.75 and somebody's offer at a price of 49, I have to eventually be willing to say, okay, I'll buy at 49 if no one's going to budge, right? So it takes a group of orders willing to bid higher and higher and higher in order for price to move higher. Same thing on the low side, okay? It's a very simple process. So when you're looking to develop a strategy, that's something that you have to keep in mind. So when you turn on your platform every day, the first thing you see are all these orders sitting out there in the order book, right? And so you turn on your platform and these orders are there. But people often never really think to ask themselves, well, from where do those orders originate? Who's placing these orders right now? This is overnight. Who's willing to buy and sell at 11 p.m. Eastern time or 1 a.m. Eastern time, right? What's going on here? Why are those orders there? So when you're thinking about approaching the game as a whole, you want to start trying to understand a little bit more about market makers and liquidity, time of day, and how these things influence the price action over the course of a certain time frame. So same thing. It's like if you're sitting there and you buy a 1 lot and now it goes from 65 to 64 in the ES. Well, there still has to be 64 more contracts bought in order just for the price to go bid at 49, right? And then they're going to have to buy 84 for price to go up, and then 65 more. So again, this is where a lot of new traders don't think through the process. If there's 400 on the bid, and 200 on the ask, and you buy a one lot, you have to think to yourself, well, who's going to buy another 200 or 300 or 500 or 800 contracts to drive the price higher? That has to happen in order for you to get paid, vice versa on the sell side. All right. So when people, let's say they look at chart trading, this is an example of an overnight move. This was just yesterday, actually. 8 p.m. the market starts sinking, dropping rapidly. This is the ES, okay, the S&P 500 minis. When newer traders are getting into trading, they look at this and what they're thinking is, well, man, how could I have known to be short, up here so that I could catch this big drop down here, right? And that's kind of the idea that they're running through their heads. And they've maybe never even seen a depth of market, all right? What they don't understand is that you have a wave of sell orders feeding on more sell orders, wiping out bids the entire way down. And this move happens fairly quickly because there's lighter volume overnight. So this is happening because you're seeing 80, 60, 70, 90, maybe only 12, 15. And it doesn't take that much volume to move the market lower very quickly, as opposed to a daytime situation. This is also the S&P, when maybe you have 200, 300, 400 at every price, right? So again, the idea is nice to think, well, maybe I could have known there was something that would have helped me understand this, but this is happening in the moment. So my point is that swing traders or longer term traders are usually trying to capitalize on moves like this, but sometimes they don't understand that this is only happening because A, there's light volume, and B, you have programs or humans continually lowering their offers in the moment, okay? So the idea behind order flow being incorporated is that you can often predict what's going to happen in the next 10 minutes of your life with a higher degree of accuracy than you can predict what's going to happen in the next 10 hours or 10 days, right? That's the idea. And then if nothing else, watching the order book helps you get better fills. So, for example, this is the Bund, this is the Euro stocks, this is the E-mini S&P. If you're looking to sell in the Bund at this moment, you have a bid of 419 by an offer of 42. That's an imbalance in the bid versus the ask, right? Instead of 400 by 400, it's 400 by 40. So if you're looking to sell, chances are you can offer at 03 and get a fill at 03 instead of selling 02. If you need to buy right now, you probably want to buy 03s instead of trying to work the 02 because you may never get the fill at 02. Now the Bund's a little bit tricky because they actually can sweep the 400 there. But it's still an imbalance. Over here in the Euro stocks, it's 824 bid by 89 offer. If I'm going to sell, I'm going to offer out and sell at 64. Almost guaranteed I'm going to get the fill there, right? And if I need to buy right now, for whatever reason, if I want to be long or I'm covering a short trade, then I need to buy 64s. Because if I try and join this, that means 800 contracts have to trade before I even get my fill, right? Over here, same thing, 65 by 12 in the ES. If I'm going to buy, I'm going to be joining the 12, right? Most people who know me know that I'm a treasury trader for the most part. That's where I keep my focus for a variety of reasons, which I won't go into here. I've discussed them in many other videos. But the same thing happens in a big way there sometimes. Like you can see this 1,300 on the bid by 24 on the offer. If I'm selling, I'm joining the offer at 19. I'm not hitting into 18.5 there, right? I'm almost assuredly going to get the fill at 19. Same thing if I want to be long right now, I'm going to probably need to pay up to 19 to buy it. Again, it depends on the situation, the context, but that little bit of just extra saving ticks throughout time makes a huge difference to the bottom line, okay? With the ES, it's a little bit different because in the ES, usually daytime, there's often a very equal amount on both sides, It's 200 by 200 or 150 by 200, something like that. So the S&P 500 is a market really where, I mean, you can sometimes see you can probably get a better fill, but if you really need to be in or out, a market order is usually warranted there because it's so fast and there's typically an equal amount of volume. So it does depend on product, and again, that's another reason why I prefer treasuries for the most part over the ES. Okay, so just something to keep in mind. All right, so let's get to some price action scenarios and some samples here to kind of help you understand some things. One of the concepts, and hopefully you can see this, you can maximize your screen a little bit. It might be a little bit small, but I was trying to keep it so you're focused just on the ES here. Maybe you're in a long trade and you're holding for a little bit longer, or maybe you're in a short trade. Maybe all this volume, this is volume, by the way, the total volume at each price so far over the course of this particular day. Maybe you're short and you're hoping the market holds below 35 and drops back down to 30, right? Maybe you're long 30s or 31s and you're holding and you're hoping the market breaks above 36, okay? So how do you approach this if the market does go a little bit higher? Excuse me, sorry. There are several different scenarios that can play out here, and I'm going to show you two of them just, again, to illustrate the point in its simplest form. This is going to be a situation where the S&P breaks highs, and it does it rapidly, and it does it on lighter volume, and this is what I would call the domino effect. All right, when I say domino effect, this is exactly what I am describing. You'll see here that as they break, they snap higher 2 points very quickly. All right, let me play this for you. Boom, you see that? Okay. So they break 35, 35, 25, and the reason it does that is because you have a lot of buy stop orders, buy market stop orders that immediately are triggered and they hit into the offers and they drive the market higher over a second, you know, half a second, whatever. And you see that it's like 698, 622, 305. That's the total amount that traded at these prices in those few seconds right there, okay? So that's a situation where the E-mini takes out highs and it does it really easily. And you see there are a lot of buy stops. They get triggered off, right? Now, long trade, short trade, whatever the case may be, that kind of information can be valuable given the right context because it's letting you know that there are buy stops at these highs. So, okay, well, if there are buy stops at 36 and 36.25, are there probably buy stops at 37.50, 38, 38.25? Probably. Again, it's an educated guess based on the current situation, but there's really no point to fade that. And by fade, I mean take a short trade or hold on to a short trade. So again, we're talking about maybe longer term trade management here. So if I'm in a short trade at 34 or 33.50 and I see that kind of quick, easy rally through highs, there's no point in holding the trade. I'm going to exit the trade. I actually already would have been out. And I'll show a treasury trade where I actually lose, illustrating the same example here in a minute. There's not a whole lot of point in going against that, okay? And the market, you know, it does hover there, but it eventually goes higher, and that's the break on a chart. So that's what we're looking at there, where it snaps through 36. And then over the course of the day, just to show you how that day turns up, that's the break that you just saw right here. And then the market spikes up. It did go higher up to 40. It pulls back in to the break point there around 36, and then makes another run higher all the way up to 46, 47 before pulling back in again to 40, 39, right? So if you're, again, a longer term trader holding into that, the odds, let's say, statistically speaking, when you see fast price action, a lot of buy stops, chances are you might be able to get more out of it. That's really just the idea behind watching the order book there, you know. And then, of course, you know, you want a trailing stop to kind of come up and not give back much of your money that you make on that that pop. But it makes sense. And on the short side, again, that's the whole point. There's no point really in going against that. And as we see the market continue to grind higher and ultimately finish the day at highs at 48. So let's compare that to a different situation here. I was trying just to show a little bit of different information. Okay. Different day. Overnight high was right here at 8. All right, market fell in, basically holds around this area. So the market starts to trade up. I'm going to fast forward through this a little bit so you can see. And it trades right up to this highs again, 750, and then drops right back down. Okay, and there's probably a little bit of a lag, so bear with me on this. I'll try not to go too fast. But what you saw there was you saw the market push up to a high point. Well, it's just overnight resistance. Quite a bit of volume trades, and then it falls back in very easily, right? So in that situation now, if you're seeing that, maybe a buy-side trade is not the greatest play here, or buying a new high is not the greatest play because it fell in pretty easily. But you can still sit back and continue to watch this. So it does it again, and it pushes back up again. Let me just kind of show you right here. They do trigger off at 8 and 8.25. I'll just let that play for a second so you can see. Right there. But what did you not see there? You didn't see what you just saw in the previous example. Okay? So the market did not spike 2 points, 2.5 points on this quick flurry of buy stop orders. They hit a tick, 2 ticks above the high, and they kind of trade back down and they hold. And what ends up happening here, what you'll see, is they struggle. Do you see that? So 8,000 plus end up trading at 8, 3,000 plus end up trading at 8.25, and the market can't even get to 8.75 there. So now if I'm sitting in a long trade, let's say again longer term, you keep hoping for the extra money, but there's information in the moment right now on the order book that's letting you know it's a struggle. It's much more of a struggle now for this market to get to new highs on light volume and to fly really fast in your favor than it was on the other day that you just saw. So perhaps, and again, you know, it's for you to decide, but the information itself might help you understand maybe I should take the trade off. And possibly I can buy back in now, even if I let it fall back in from 8 to 6 or 8 to 4, right? Take some of the trade off or all of it, 725, 750, even 675, probably going to drop back into 5 again. Buy back in if you still like to trade at 5 or at 4 or at 3, right? Same thing if you're looking at it from the short side. It's a situation where it's kind of a reinforcement of your idea. I'm short there. Looks like 8s are holding. Yep, a lot of volume's trading. They're still holding. They're still holding. They're still holding. Really not a reason to blow out yet. Let's hold this, see if it drops back into 5 or 4 again. All right. So very simple as far as the explanation. But again, just trying to appeal to people that don't have a lot of knowledge on the subject. Something that can help you in the moment. Now, I'll show you how, I've used this myself in treasuries. These are the treasury markets with the ES on the right. So this is the 10-year, the 30-year, the 5-year, and the ultra bond. I'm currently long at 5.5 in the treasuries. And I'm showing the sample because often people who attend these, they think that the presenter cherry picks winning trades. So this is to show you management of a losing trade, all right? And how I pretty much know I'm on the wrong side and make the call that I definitely should be out of the trade. Exact same concept in a different market, all right? I'm long 5.5. I hold the trade for a little while because it's a situation where they do trade through me by a tick. Right here you can see they trade down a little bit, and then they come back up. And it's the kind of spot where I held the trade because it was a situation where if the buyers can hold it, I know that the market might rally back up 4, 5, 6, 6 fairly easily if it starts to go. Okay, it may not, but if it does, once it starts going, it should be pretty easy to get paid a little bit on the trade. And I sort of have to hold through it based on my own assessment to figure out whether or not it works. All right, I didn't want to break even on the trade. I wanted to be in the trade to win or to lose. It was that kind of a trade for me. So let me show you what happens. So I have a stop already set at 3 ticks lower, but I'm going to show you why I knew I should definitely be out of the trade. The market trades down. Let me show you something. Sorry. If you look at the bid at 4.5, there's 2,495 contracts on the bid there. Okay? Right now. Now, as the market then goes offer at 5, you see that drops to 1,700. Nothing actually traded, though. Again, this is the advantage of the order book, watching the depth of market. Nothing traded. Those are orders that canceled. So it goes from 2,500 to 1,700, 1,750. So I lose 750 contracts on the bid. All right. Now, when they actually do trade at this price, let me show you. If you look at the total amount here, you're going to see that it only equals 757. Right there, 755 at the moment. I think it goes 757, but what that means is at one time there were 2,500 on the bid at 4.5, but when it actually traded, only 755 trade. And then no one comes back into that price, and then orders start hitting in the 4. Okay? When that happens, that's absolutely not what I want to see when I'm in a long trade. I don't want to see 757 here. I want to see 12,000 there or 10,000. You know what I mean? I want to see size supporting my position. If there's only people willing to buy 700 contracts there, the market's almost guaranteed to go to at least 3.5 in this situation. Nothing's guaranteed in life. But the point is, it's probably going against me. So, I end up blowing out a trade right here at 4. I ended up getting the fill. Right there. So I ended up taking the loss of 3 ticks in the trade. And then just to show you, I jumped ahead a little bit. Same situation. That's the 757 there, right? It traded back and forth at 4 and 3.5 a little bit. So there's a bit more size there. But now it's trading 3. Now it's trading 2.5. And so the market ends up trading lower from that point, right? It's a really fundamental concept which is imparted when you're learning how to trade at firms. You're trying to find situations where the money is easy and where it's not taking a lot of volume to move through prices, and the market orders just keep banging away at either the offer or the bid. And that's how it works, right? So obviously I don't want to be long if 757 trade there. Okay. Very simple premise, something that might help you down the road. That's kind of the idea. And then another situation, another reason that firms kind of keep their traders focused on short-term trading is for opportunity costs, right? Or based around opportunities. So often people who watch the depth of market and they're a little bit shorter term oriented, they can find multiple trades in a situation where a longer term trader may only find 1 trade or 2 trades, right? So particularly during a busy period, a short term scalper may end up firing 5, 8, 10 trades off. And then a sample of that would be like a range play. Sometimes a short term range establishes itself, and you might be able to sell it. It goes lower, you buy and you cover. You don't only buy and cover, you buy and reverse and you go long. And then the market goes back up, and then you cover and then you sell it to go short again, and then it drops back down. Or maybe it goes through you. But sort of the point is, in a situation like that, you might be able, if you hit once and miss once, then you come out, flat. If you hit twice or more and miss once, then you're probably going to be in the green. You know what I mean? And a very simple sample of that, I have another sample of that, is this situation, which wasn't perfectly managed, but I ended up taking a short trade up here at 23.5. Right here you can say get my fill. Some time goes by, the market falls in. I end up getting a few ticks on it right here. It goes 22. I wasn't sure if the market would drop. I mean, obviously, sure, you're never really sure. But I didn't have much of a read on how far it would go. So I ended up taking 3 ticks on it right there. It ends up being a little bit too quick as the market drops farther than that by a few ticks. But eventually, I play the top, it falls in, and then it gets down here to 19.5, 20, 20.5, and I'm going to jump forward to that. And so then it gets down to that area, and there was nothing in between here. And you trade a ton of volume, as you can see, 88,000, 83,000 total at these prices. And I end up buying 20s, and I set through quite a bit of that. And again, I have a 3-tick stop. So I make 3 ticks playing the high. Even if it goes through me and I lose 3 ticks, I'm net flat on the play, right? But the idea is I'm playing it to go back up again, and then possibly even going to short again if it gets to 23.5 again, and play it on the way back down. And so in this situation, the buyers end up holding it. It ends up going back up a bit. It takes a while. Treasuries are different than the ES. And I keep following it up with, trailing stop, and then eventually I make the decision to just go ahead and pocket the 4. Because I did not think it was going to go to the highs, essentially is what happens here. Sorry. It's right there. So it just kept holding in this area, and I didn't think it was going to get back 23.5. If it did, I was planning on selling 23.5s again as well and going the other way. So ultimately, I end up offering out and taking 22s right here. The point being that that's the kind of situation that usually your longer term traders right there get taken out. They're not thinking about trading in that regard, right? They are looking at it a bit more from a long-term standpoint, and it's like win or lose. And they're risking 8, 10, 12 ticks, and they want to make 15, 20, or whatever the market is, right? If you're trading oil, maybe you're risking 25 ticks to try to make 60 ticks. And so sort of going back to what I was saying earlier, just in case anybody's wondering, in the interview, he asked me about it being helpful, and I said no because I didn't really have an answer ready, but it definitely can be helpful to longer term traders. And sometimes people, post thoughts as if they know the inner workings of my mind, which they do not, saying that, again, I only believe in scalping or whatnot. That's not the case at all. And if you ever have questions, I would invite you to email me directly first, and I'll tell you exactly what I think about things. And then, of course, research it on forums like Futures.io, and talk to other people about it. But those are some of the ways that you can use the ladder to help you with trades. And of course, the bid ask, saving that tick on the bid ask really does add up over time. And the last thing I only want to discuss on the presentation really is just context. I discuss this in pretty much every presentation because it's very important. And to summarize it, the action after a number, like at 8:30, for example, the employment number is for the U.S. is released at 8:30 a.m. on the first Friday of the month. Usually the first Friday, sometimes it's the second, depending on like if it's right after Christmas or something. During that time frame, the markets are going to be moving, guaranteed 100%, right? On a Tuesday with no news at 12:30 p.m. lunch hour, the markets may barely be moving at all. So when you're contemplating, again, the strategy that you're using and whether or not you should be involved, you probably want to look to be involved during times when there's going to be volatility, because you have to have volatility to make money. I mean, it's really that simple, right? Market has to move. So same thing, if you're a longer term trader or you've been using some longer term strategies, you do have to question, if you're sitting in a trade at 1 p.m., or 12:30 p.m. and the market's barely moved in the last hour, what do you really know, or what information do you really have that's giving you some kind of clue to the direction in the next 30 minutes or hour or 2 hours, right? Probably a little bit better for you to focus on situations where there's going to be volatility, maybe even news events as well, responding to news events. At the beginning of the month, there was that attack in Iran, and the markets, went pretty crazy when that happened. And there was sort of a longer term trend play. Well, not that long term, but, it was there. There was a trend play for 20, 30 minutes anyway. And, when that happens, I wasn't watching at the time because it was in the late afternoon, but there's no point in going against it. If there's a big news event, if there's some announcement that Russia's cutting oil or OPEC's cutting oil or something of that, nature, there's zero reason to go against the news. The trend's there. People are going to react to it. Programs are going to react to it. There's going to be a domino effect. So kind of regardless of what you're seeing in the volume, you have to pay attention more to the price action and how fast it is and what's happening. So you're not really looking just to scalp a few ticks in those situations, but during normal times, you can often find more opportunities. Okay, so with that, I would like to open it up to any Q&A.
Okay, if you have any questions, type them in and I will ask them to John. Let's see. Would this work on currencies in Forex?
It doesn't, currencies on the CME, I get that question a lot. They are a bit more transparent like this, right? They're trading on the CME, and so it certainly is a factor to take into consideration. I'm not a fan of Forex, and if you kind of read up on anything about it, you'll understand why. Forex, you're dealing with broker-dealers, and there's a lot more to it. And in fact, somebody else who presents on here is Peter Davies of Jigsaw Trading. He recently posted an article that really goes into depth on this, and it's about futures and stocks versus Forex trading. If you can find that article, just Google it. It explains it, but ultimately, it's not a centralized exchange. So on the CME, I would say, yes, your odds are better. On Forex, I would say not so much.
Okay. I think this was to a clip before me. It says, how does that 200 on the offer get hit so fast?
On the ES thing right here. So that's what happens when you have that many buy stops being triggered at one time. So what happens is there are going to be orders out here that are already there. Let's say to buy 10, to buy 20, to buy 5, to buy 100, and they're market orders, which means if they don't get the fill at 75, they're going to immediately go for 6 even or 625 or 650, and they all trigger at the exact same time. So you end up literally having thousands of contracts being set up to buy if the market makes new highs, and they all trigger at once, and they all hit the exchange at one time. And that's what happens.
Okay. Okay, let's see. When I have a positive outcome for the first trade of the day, I suddenly become reserved from taking more trades. But when I lose the first trade or two today, I try to trade as much as possible to the point where I can even wipe out profits from previous days or weeks. Any suggestions on how to overcome this?
That's very, very much a extremely common trait. It's It's a psychological thing, and it's a little hard to honestly address in 5 minutes on the Q&A. I would recommend doing a lot of reading on your own psychology. There are some guys out there that talk about trading psychology, and one of the things you have to remember, though, that might help you with this is that if you do come out of the gate doing okay and you've made one or two good trades, it may very well be that that day is going to be the right kind of conditions for your style. And you don't want to keep pushing it necessarily all day, or if you're, you don't want to overtrade. But what a lot of novice traders don't understand is they approach trading as this job where they want a daily paycheck, and it doesn't really work that way. The way that it works usually is you make the brunt of your money on days when the conditions are really good for your style, and then on days when conditions aren't good for your style, the idea is you just don't trade at all, or maybe you take that one loss and you realize this action's not for me and you have to quit. So it's a combination of both recognizing what suits your style and trying to press that advantage, but also realizing that you're hardwired to not ever want to lose. That's a product of our educational system, quite frankly. And you have to rewire your brain to view it as, it's not a day-to-day thing. You have to view it from a month-in standpoint and a year-in standpoint. And if you can do that, your odds of success are much better.
Okay. It says rating the DOM on futures, I understand, but would the level 2 on stocks be equivalent to this?
The level 2 on stocks is equivalent to this, but let me help you out. I'm going to plug Pete again. You're going to be able to use a ladder with stocks very, very soon. In fact, you already can. He's working on running the feeds through, this is what Jigsaw is what I'm using right now, but I mean other platforms I believe are also focusing on this as well. But it's going to be a big game changer. And so, yes, it can be very difficult to read the level 2 platform because it's in penny, stocks are in pennies, and you have the split from the left to the right, and then you have a separate time and sales. So the concept is still the same. Like, you kind of want to watch whether they're sweeping through 10, 20, 25 cents really easily, and the time and sales showing lighter volume. But once you're able to connect these ladders into the equities, you're going to be able to follow the action a lot easier. So I would tell you to keep on the lookout for that and incorporate it into your equity trading as soon as you can.
Okay. It says, I noticed you were trailing your stop closely. Is that common for you to do in a standard move? When would you move your stop to break even or trail up?
It is. It's for what I do. It's very common. And particularly in treasuries, and that's because treasuries don't move like the stock indexes. So typically for me, I sort of know if the 10 years move 3 ticks in my favor and I'm kind of right, it should not come back to my entry price usually, unless it's a small range. So once it's moved like 2 in my favor, I usually move my stop to break even on that. With the S&P, it's a little bit different. But typically, yeah, if I catch a breakout in the S&P, I usually move the stop immediately to break even. Like if the S&P jumps 5 ticks in my favor, stop goes to break even right away. Sometimes I get taken out and then it keeps on going, but that's just my particular style.
Okay. You're a big promoter of recording trading sessions. I have started to record mine, but I don't know how to study these sessions effectively. Any suggestions?
I would say first you want to focus on the context. So that's what I was discussing at the end of this presentation. If you're watching the recording, what you want to notice are some of the things that I mentioned. You want to notice whether or not the ES jumps through a high very quickly. What's the pace of activity? Are trades going off every second, or are trades only going off every 10 seconds, 20 seconds, right? That would be your first thing, is pace of activity. It's what I call continuous flow, meaning do you have a continuous flow of orders hitting both the bid and the ask pretty much every second? And then from there, types of days, right? You know, what happens on the non-farm Friday, what happens around GDP, what happens around durable goods, what happens at 8 to 9 a.m., what happens at 9:30 to 10:30, what happens from noon to 2, kind of like categorize it, break it down, and start focusing on when you're noticing the best volatility, when you're noticing the pace of activity being fast and slow, things of that nature. That's where you start. And from there, once you get a feel for that and how the context plays such a role, then you can start kind of micromanaging a little bit more and looking at bids and asks and prints.
Okay. Let's see. What is your clear trades parameter setting?
Clear. 10 seconds. It's a setting within Jigsaw or whatever you use.
Okay.
But yeah, what he means there is these inside that show the uptick downtick prints, the split. Those will clear out. You can set it to whatever you want. So I have mine for 10 seconds. Some people like a little bit less. I don't suggest much more than that because it starts to become too much. But 5 to 10 seconds is good for most people.
Okay. Do you take dark pool large block orders into consideration?
I do not. They really don't account for a huge amount of the volume. Trying to track those is almost impossible anyway. So you pretty much have to, being a retail trader, you have to try to take advantage as best you can with the information you have. So because there's also there's the cash markets too, right? So again, it's a little bit different with treasuries. But if you're trading the stock indexes, you should absolutely have the cash indexes up, right? I mean, you kind of have to keep that in mind. I was just having a conversation with somebody a few days ago. You have to keep in mind that you have the Dow Jones, you have the S&P 500, and then you have the NASDAQ as your main indexes. So if even one or two stocks like Apple and Microsoft, which have been driving this massive run, if they get a sudden buy order hits just those two stocks, that's going to drag the cash index up, which is going to drag the futures up with it, right? So if you're trading stock index futures, you kind of want to be involved in watching various things like that. In other products, that's not really necessary, and so with treasuries, you can typically focus just on what's trading there and maybe some other markets and make a decision based on that.
Okay. He says, I trade the ES and crude, and my best trading takes place around news and events and breakouts. I have been thinking about trading treasuries, but I'm wondering if it would be fit to my style since I'm looking for those high volume, one-sided moments in the markets. What suggestions do you have for someone who's primarily traded faster markets?
I would say give it a shot as another avenue. You are going to find that they're slow, but what you'll also find is that you can often manage your risk a lot better. So in other words, there can be scenarios in the 10-year where the market shouldn't even go against you really 2 ticks if you're right. And so it's kind of with confidence that if the market moves 2 ticks against you, not always, but sometimes, you just blow out, right? And then if the trade's good, it's going to yield two ticks or more. That kind of thing is very hard to identify in the indexes and certainly in crude, right? So what you'll find are slower markets that are thicker, but that might yield better consistency in terms of accuracy or winning percentage, let's say. And then you also may not encounter the same kind of swings in your volatility, P&L volatility. So I highly recommend that. A lot of guys have converted to treasuries from the ES that have talked to me, but you can do all 3 of them. It's just a matter of you have to be able to switch gears.
Okay. Let's see. Okay, we got about 5 minutes. Let's see. What is your reasoning for not using the snapshot columns?
So the snapshot columns, for those who don't know, are columns that you can add that would show you, for example, when this order that I was talking about here, so there's 2,500 there, and then that drops down to 1,700. Fast forward it. Right there, see that? So it's a column that would show you that 700 canceled. The reason I don't use them is because I learned without them. So you can kind of keep track in your head just watching what's going on there. Not so much in the ES, but in treasuries, absolutely. In the bund, absolutely. Euro stocks, absolutely. And it really just takes up more screen space. So it's kind of a cool tool just to help you learn, but I do actually recommend you drop them eventually and conserve your screen space. And you'll find that it's not as hard to follow the changes as you think it is. It's difficult in the beginning, the same way it's difficult to watch 2 in the beginning. And you see I have 5, but I mean, you can actually watch 8 or 10 of them at once. It's like multi-table poker once you get used to it.
Okay. Okay, I answered all those. What time do you start trading the treasuries?
I usually start watching about 7:30 to 7:40 a.m. Eastern time. Sometimes there's movement around then, but the number releases, the big ones always happen at 8:30 a.m. Well, most of them do. So you have employment, durable goods, retail sales, GDP, CPI, right? Those all happen at 8:30, and the treasuries often offer much more opportunity at the 8:30 than the stock indexes do, because the stock market's not open yet. The treasuries are in full swing at that point. So if you're going to trade them, I'd recommend starting to watch them about 7:45 a.m. and definitely be there at 8:30 on the days when there's news events.
Is the UB a better trade than the ZT?
ZT being a 2-year or 10-year ultra, I forget at the moment, or 10-year ultra bond. I would say I can answer it either way. The UB is thin, and you probably shouldn't focus on that in the beginning. You're more likely to get whipsawed. If you want something thinner, you go with the 30-year, which would be this one over here. You have a bit more size. That's the UB over here. So you're liable to get swept on the ultra way easier. So in the beginning stages, try something thicker and then maybe go to that once you have a feel for it.
Okay. All right, I'm gonna make this the last question. It's the volatility in crude is appealing, but I've heard people don't like it. What is your thought on scalping crude?
I don't do it. That probably summarizes it. For the reasons I mentioned, it is very fast, it is very volatile, and you're right, it's appealing. And unfortunately, the newer traders typically do want to try to come in because they don't have much money and they want to swing a one lot in crude or gold and make $1,000 a day. So I would say you just have to look at potential consistency and how quickly you can get blown out. Try to keep in mind that those markets are dominated by the energy companies. I mean, people sort of forget, like BP and Shell and people in the Middle East trade those markets, as well as some hedge funds. So you would really have to kind of learn the market very, very well and what the typical volume is. But I always point people towards thicker markets in the beginning, be it treasuries, be it the ES, maybe the bond, and Euro stocks on the Eurex markets. Something with a little bit of thickness, just to get a feel for how trading works in general. And then if you want to try your hand at thinner markets, have at it and see what happens.
Okay. Thank you for the webinar and the information, and for spending some time with us this evening.
Thank you, Terry, and thanks to Mike. I appreciate it.